In 48 hours, more than $2 billion in leveraged positions vanished from screens around the world, while the headlines tried to sell it as a routine pullback. Not months, not weeks, 48 hours. Bitcoin dropped about 12% and slid to just under $64,000 on February 5th, 2026, and Ether was already down dramatically on the year, with the broader market wobbling as if the floor had quietly shifted. They said the system was deeper now, more liquid, more mature. They said the weak hands were gone. And yet, the moment volatility showed up, the market behaved like a crowded room with one exit. Here's the part most people miss. When you see billions liquidated in a tight window, that's not a crowd voluntarily changing its mind. That's the market's plumbing snapping shut, its collateral rules, margin thresholds, and automated risk engines pulling the lever at the same time. Institutions already understand this because they build their strategies around it. Most people only notice after the chart is already scarred. What I'm about to walk you through isn't a conspiracy story, it's a mechanical one. It's about how a dump can be manufactured from conditions that look perfectly calm right up until they aren't. It's about why the public narrative always arrives after the damage, and why the data, if you know where to look, tells a cleaner story than the talking heads ever will. Welcome to Roki Signals, where we decode what matters before it becomes the headline everyone repeats. If you like analysis that follows the numbers instead of the noise, you'll feel at home here. And if you're listening the way you'd listen to that wise elder who's seen a few cycles, you already know what to do. Drop a comment with where you're watching from, because the most interesting thing about markets is how global the reaction really is. Now, let's reconstruct what actually happened. On February 2nd, 2026, the market started to show the first crack. A sudden slide that left Bitcoin down roughly 4% in 24 hours, and Ether down around 10% in that same window as a liquidation. Totals pushed past $2 billion. That number matters. $2 billion is not a mood swing. $2 billion is a system event. It means leverage was stacked, positions were crowded, and the exit door was narrower than the crowd believed. By February 5th, the selling pressure had compounded. Bitcoin traded down to just under $64,000, roughly a 12% drop in the span that mattered, and the year-to-date pain was unmistakable. Bitcoin down about 25% on the year, Ether down about 37%, with Ether trading around $149 in the same period. Those aren't just red numbers. They're evidence that the market was already weakening while positioning sentiment and risk appetite indicators were still being discussed as if the party was intact. And here's the central mystery. If this was just a normal, organic repricing, why did it require that scale of forced liquidation to achieve it? Why did the move accelerate the moment the leverage got squeezed instead of drifting lower as sellers chose to exit? Well, the answer is uncomfortable because it suggests the dump wasn't simply a reaction. It was the inevitable outcome of how the market was set up. To understand that, you have to zoom out and recognize a pattern markets repeat with almost embarrassing consistency. In 2008, the story people told was about housing and a few bad loans. The story the tape told was about leverage, collateral, and funding market seizing. When short-term funding froze, forced selling followed, and the why arrived later in 1,000 postmortems. The pattern wasn't mystery, it was mechanics. In 2018, when volatility products imploded, it didn't happen because everyone woke up with the same fear on the same morning. It happened because the structure of those products forced buying and selling at the worst possible time. A spike hit the right trigger levels and the unwind fed itself. The public explanation came later. The structure did the damage first. In March 2020, the world had a real catalyst, but the speed of the financial collapse was still a function of plumbing. Margin calls, forced de-risking. Funds selling what they could, not what they wanted. The market wasn't negotiating, it was liquidating. Now in 2026, the same pattern is showing up again, but with a modern twist. Leverage is everywhere, and the liquidation engine is instant. When the market is calm, leverage looks like a tool. And when the market twitches, leverage turns into a trapdoor. This is not opinion. This is pattern, and the pattern has a tell. It's when positioning indicators scream crowded, even as prices still look stable enough to lull people into complacency. 6. The most extreme reading in 2 decades. Think about that. A 20-year high and everything is bullish. Positioning while markets were already fragile enough to produce multi-billion liquidation days. That contradiction isn't just interesting, it's the setup. Because when positioning gets that one-sided, the market doesn't need a major news event to fall. It only needs a small push in the right place. And the right place is almost always leverage. So who is moving and how can you see it without guessing? Start with the institutions that operate closest to the plumbing. Exchanges and clearinghouses don't care about narratives. They care about risk. They adjust margin requirements, collateral rules, and haircuts based on volatility and perceived stress. Those adjustments can be justified as prudence, but their timing can also turn a wobble into a cascade. If you've watched commodity markets, you've seen this play out. Margin goes up, weaker hands are forced to close, price drops, volatility rises, and margin goes up again. It's a feedback loop. Necessary for whom is the question most people never ask. During this same window, traders were already discussing margin moves in futures markets as a volatility accelerant. One example being highlighted was a jump in initial margin for March 2026 silver futures to roughly $25,000 from $20,000 earlier in the month. That's a $5,000 increase per contract, not theoretical, per contract. It changes who can stay in the game and who gets pushed out. Now, this script isn't about telling you silver and crypto are the same market. They're not. The point is that the mechanism is the same across markets. Change the collateral equation, and you can force selling without needing a headline catalyst. So let's talk dislocation, because dislocation is where the setup becomes visible. A normal sell-off looks like synchronized weakness. Price falls, volatility rises, risk premiums widen, and related markets confirm the move. But engineered or structurally amplified sell-offs often show something else entirely. Two data streams telling opposite stories. Those explanations sit comfortably in a studio segment. They require no uncomfortable discussion of leverage, liquidation engines, or the fact that the market's apparent depth is an illusion when everyone is positioned the same way. The second stream is the liquidation tape. More than $2 billion in positions forcibly closed in a short span. That tape is the market confessing. It's saying the move wasn't primarily about voluntary selling. It was about rules that turned a drop into a stampede. Here's where it gets interesting. If forced liquidation was the driver, then the real question becomes who was positioned to benefit from the stampede and who was positioned to survive it. Institutions don't need to predict the exact day of the flush. They only need to recognize when the market is structurally vulnerable and position accordingly. That can mean reducing leverage, tightening risk, shifting to option structures that benefit from volatility, or holding liquidity to buy after forced sellers clear. Retail, by contrast, tends to be positioned for continuation, because continuation feels logical right up until the moment it doesn't. So what evidence can you point to without guessing motives? First, the scale of liquidation. Again, over $2 billion. If you've ever watched the market on a calm day, you know that kind of number doesn't print unless leverage was stacked. Leverage gets stacked when the environment rewards it for long enough that participants believe the reward is normal. Second, the speed of the drop. Bitcoin falling to just under $64,000 on February 5th, 2026, with a roughly 12% move in the relevant window, alongside a year-to-date decline of about 25%. Those are not gentle numbers. They suggest the market was already bleeding, and the flush simply revealed it. Third, the broader risk backdrop. 6, a 2-decade extreme, it's telling you consensus positioning is stretched. Stretched positioning doesn't cause a sell-off by itself. It makes the market brittle. Brittle markets break under small stress. Now let's make the mechanism simple, because complexity is where most people get lost. Imagine a crowded theater with one exit. When the show ends normally, everyone leaves calmly. When someone yells, "Fire," people don't walk out. They surge. The exit doesn't change, but the behavior does. In markets, leverage is the crowd. The liquidation engine is the surge. Margin requirements are the width of the door, and volatility is the panic. When price drops, leverage traders hit maintenance thresholds. If they can't add collateral fast enough, their positions are closed automatically. Those forced closes push price down further, which triggers more forced closes. It's not a debate, it's a loop. And it can be triggered by smaller moves than most people realize when positioning is one-sided. This is why the phrase, "it was just profit-taking," is often a late story. Profit-taking is slow, liquidation is fast, and the data showed speed. Now layer in something even more important. Policy and rule changes can tighten the door right when the crowd is heaviest. In futures and cleared derivatives, margin changes can force participants to post more collateral immediately. If they can't, they reduce positions. That reduction is selling, not because they changed their thesis, because the rules changed. And when enough participants face the same rule change, the selling looks like a coordinated dump, even if it's simply coordinated stress. That's why margin is such a powerful lever. It's clean, it's mechanical. It doesn't require secret meetings. It only requires that the system responds to volatility by demanding more collateral, and that participants are leveraged enough that they can't meet it. And once you understand that, you can see why the public narrative arrives late. Because the narrative is written for comfort. The mechanism is written for survival. Now, the title of this episode is Rigged. The dump was a setup. Here's what they don't want seen. And the word rigged gets abused online. So let's define it in a way that stays grounded. A market can be rigged without a single illegal act if the rules, incentives, and timing systematically advantage the players with the best access to liquidity and collateral. That's not a moral claim, that's a structural claim. You can see that structure most clearly in metals, because metals trade in two worlds at once, the paper world and the physical world. Paper markets can expand supply instantly through contracts. Physical markets can't. When those two worlds drift out of alignment, you get the kind of dislocation that doesn't show up in a simple price chart. Think about what happens when futures volume surges while physical availability tightens. Paper prices can be pushed by flows that have nothing to do with immediate physical demand. Physical premiums, delivery timelines, and inventory behavior can tell a different story. That gap is the dislocation. And dislocations are where forced selling becomes a tool because it hits the paper side first. This is why margin policy matters so much. Margin is the price of participation in the paper market. Raise it, and you shrink the pool of participants who can keep positions open. If they can't fund the position, they're out. When enough participants are out at once, price reacts and the move looks like a sudden dump. In 2011, silver surged and then collapsed in a matter of days, and the tape showed something familiar. A series of margin increases landed as volatility rose, forcing leveraged longs to reduce exposure. Again, the point isn't whether someone wanted price down. The point is that the system's response to volatility can produce the same outcome as intent. In a leveraged market, the rule book is a weapon, even when nobody calls it one. And in 2026, you can feel the same tension when the initial margin for March 2026 silver futures is discussed as jumping to roughly $25,000 from $20,000 earlier in the month. That's not trivia. That's a clear change in the leverage equation. And in crowded trades, higher seat prices force people to stand up all at once. Here's where the crypto sell-off and the dump narrative rhyme with metals. Crypto markets have their own margin system, often embedded in perpetual swaps and derivatives venues with automatic liquidation engines that act like exchange rule changes on a rolling basis. When volatility rises, risk parameters tighten. When risk tightens, leverage gets cut. When leverage gets cut, price drops. And when price drops, more leverage gets cut. Different asset, same loop. So when you see a sudden flush that coincides with extreme positioning readings, you should immediately suspect a setup in the structural sense. The setup is the crowded trade. The trigger is a volatility move. The accelerator is collateral and margin. And the outcome is forced selling that lets stronger balance sheets buy or cover into weakness. That brings us to the players because this doesn't happen in a vacuum. At the center of most modern market cascades are clearing structures. On one side, you have exchanges and clearinghouses that set margin. On the other side, you have clearing members and prime brokers that decide how much credit to extend to clients, what haircuts to apply, and when to reduce exposure. Then you have large funds that choose how much leverage to carry, and market makers who manage inventory and spreads as conditions change. None of these players need to coordinate in a smoky room for the outcome to look coordinated. Coordination can emerge from shared constraints. If everyone uses similar risk models, everyone reacts to the same volatility in the same direction. If everyone watches the same collateral metrics, everyone tightens at the same time. The market becomes a synchronized machine. Price might move 4% or 12%, and commentators call it normal. Stress, measured by liquidation totals, funding spikes, widening spreads, and sudden drops in depth, screams something else entirely. That's why the $2 billion liquidation print matters so much. It's stress exposing itself through forced behavior. This is also why institutional positioning can look contradictory to retail interpretation. 6 at a 20-year extreme, it's telling you the crowd is already leaning. Institutions don't need to predict the next headline. They only need to know the crowd is leaning so far that a shove will do the rest. Now let's tie the dislocation to something tangible. In many markets, the paper side can trade enormous notional value with relatively small real cash. Moving, because derivatives net out and leverage amplifies exposure. Physical supply chains don't work that way. Physical has transport, storage, fabrication, and delivery. When paper flows dominate price discovery, you can get moments where the official price drops, while physical buyers quietly report longer lead times or higher premiums. That doesn't mean shortages are guaranteed. It means the two worlds can disagree. When those worlds disagree, the disagreement can't persist forever. Either physical conditions ease and the paper price makes sense again, or physical conditions stay tight and paper pricing becomes unstable because delivery risk matters. In metals, that tension shows up around delivery cycles. In crypto, that tension shows up around exchange flows, custody behavior, and the difference between spot demand and derivative leverage. And in both cases, the market's easiest lever is leverage itself. You don't have to change the fundamental story to change the price. You can change the collateral math. So when you hear dump, translate it into a question. Was this selling driven by choice or by constraint? The liquidation number answers that question more often than any pundit does. So what does this mean going forward, based on what these patterns have always led to historically? Historically, after a forced liquidation event of this magnitude, one of three things tends to happen. In the conservative scenario, the market stabilizes as leverage is cleared. Volatility cools, the liquidation engine quiets, and price grinds sideways while participants rebuild positions cautiously. The key signal in that scenario is shrinking liquidation totals and tighter intraday ranges. In the moderate scenario, the market attempts a rebound, but collateral conditions tighten again. That can happen through another volatility spike, another rule adjustment, or a macro shock. Price then experiences a second leg down, often less dramatic than the first, but psychologically more damaging because it destroys the "that was the bottom" narrative. In the aggressive scenario, the market realizes the flush didn't solve the underlying imbalance. Liquidity thins, confidence fades, and forced selling spreads from one pocket of leverage to another. That's when you start seeing cross-market stress. Correlations jump, funding becomes expensive, and the calm narrative can't keep up with the tape. Notice what's missing. Predictions, guarantees. The only honest thing to say is that historically, forced liquidation is not the end of the story. It's a chapter change. It tells you the market was over-leveraged and that the system is now repricing risk. So what should you watch if you want to understand the next chapter? Watch liquidation totals, not opinions. If you see another cluster of billion-plus liquidation days, it means leverage is rebuilding or stress is spreading. Watch volatility, because rising volatility often leads to tighter collateral demands. Watch funding rates and borrowing costs where you can, because expensive funding is the market's way of warning that risk is being repriced. And watch for margin rule chatter in cleared markets, because those changes don't just respond to volatility, they can amplify it. Now we need to talk about the divide, because this is where the title earns its weight. The divide is not between people who are smart and people who aren't. The divide is between people who understand the plumbing and people who only understand the story. Markets are not fair narratives, they are systems. Systems have triggers. Systems have feedback loops. Systems punish crowds. Institutions move first because they're designed to. They have risk committees, models, and access to real-time positioning data. They adjust before the headline. Retail moves last because retail is taught to interpret markets through stories. By the time the story is clear, the move is already priced. That's why dumps feel like setups, because structurally they are. Not in the sense of a secret plot, but in the sense that the conditions are built long before the event. Leverage builds, positioning crowds, collateral rules tighten. A small move hits a threshold, and the market does what markets always do. It clears the crowd. If you've ever wondered why it always seems like the drop happens right when confidence is highest, now you know. Confidence is leverage in disguise, and leverage is vulnerability. So when someone says they don't want this seen, interpret that in a precise way. The thing that isn't discussed is not a hidden villain. It's the mechanism. It's the feedback loop. It's the uncomfortable truth that the market's most dramatic moves are often not driven by new information, but by old positioning colliding with mechanical rules. And once you see that, you can't unsee it. You start noticing how often the largest moves happen when the explanation is weakest. You start noticing that the real news is usually the structure, not the headline. This is Roki Signals, where we decode what matters before it's everywhere. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether markets will keep running this playbook. The question is whether you'll recognize it while it's happening, or only after it's already been written into the story.